Today, we're so excited to delve into the global markets, the monetary system, and all things macro with David Levenson. David's a longtime Wall Street veteran who started his career at Bear Stearns and then worked in the hedge fund world for Steve Cohen and a few other portfolio managers over the years. David's a fixed income expert and has a unique thesis on what's going on in the global markets, which I'm sure as of today, now with this market close, people want and need to hear about. So we thought it would be important to bring him on. And especially since we're sitting at this turning point here, welcome, David. We can't wait to get into it with you.
Well, thank you so much for having me on, Nadine and Ben. There are just so many areas that we'll be able to focus on and really identify what's essentially driving this, in our view, very organized market that's behaving according to a model, a standard model. And if you get that insight, it'll really help you out in terms of understanding where the market's going to be going.
Well, this sounds interesting. So before we get into the model details, though, and the conversation, I want to start by addressing what we're going to call the invisible gorilla in the room. Our friend of the show, Hugh Hendry. Last fall, we were fortunate enough to have him on as a guest, and he talked about his discussion with you and how it inspired him and his thinking about the coming end of cycle dynamics, which he referred to as the invisible gorilla. So I imagine you know a little bit about this, but could you start out by telling our listeners what exactly the invisible gorilla is that Hugh was referring to, and more specifically, what are people misunderstanding right now about what we're seeing as maybe chaotic dynamics, right? But you're seeing more as what you are now saying is like a pattern of a model.
Well, when you're talking about the gorilla in the room, you're talking about, or the invisible gorilla in the room, you're talking about an operating or controlling principle that people don't even notice. And they're being distracted by other things. So the single most important thing in all markets is fixed income. Of the globe's $625 trillion and $2 quadrillion, equity typically represents only 10 to 30%. And anyone who's ever worked on Wall Street, at a large firm, at a dealer, all they know is whenever there's a problem and things are getting chaotic, you call the bond guys.
Right.
Because their market dominates. And much of the time it doesn't. And you can buy and sell, and everything you're looking at is related to earnings or current interest rate or seemingly a policy. But what fixed income wants to do, all those rules don't apply. And we're now in that E2, A2, O2, everything, everywhere, all at once opportunity. Everything is breaking down the rules. We're approaching a correlation coefficient of 1 where things will all follow the rotation of the yield curve. And policymakers, since the beginning of the removal of the dollar peg on August 15th, 1971, in an Oval Office address by Richard Nixon, we've becoming closer and closer to the dominance of fixed income. And ever since then, all policymakers want to do is debase the dollar and steepen the yield curve, because steepening the yield curve is like opening the liquidity pump. Debasing the dollar printing is opening liquidity spout. But there are times when so much liquidity has gone to so many improper places that the deleveraging is required before progress can be made. And that is the curve rotation. And we go through it today, and you'll be able to see the different things the Fed and the administration, Biden, and OPEC and Europe have done to try to interfere with the propagation of the yield curve flattening through time. But when we get that, we get the giant reset. And then we get the opportunity for the greatest bull market that ever will have been. But we have to go through the process of pricing in policy.
So we're pricing in policy, and let's start with the most ridiculous policy intervention, which started with COVID, right? And then couple of years of it, where we, I guess 22, they kind of dialed it back a little bit, but then they reaccelerated it all the way till now. Just like talk about like how you think about those dynamics and how that created the excess or capital misallocation, if you will, which is my Twitter handle, that's getting us now, whereas we come to the refi of the COVID debt, and there maybe was some capital misallocation, and we'll have to do what you said as a deleveraging. We talked through it a little bit.
So when we had COVID, it was a novel experience in modern capital markets. We had a voluntary shutdown. It was not an economic event like the global financial crisis. It was not an economic event like the bursting of the dot-com bubble. It was not an economic event like long-term capital management. We can go all the way back. What it was a collective voluntary choice to make a financial choice to save lives. And what that did mechanically is create the greatest when you get a little older, sometimes the mind
It's Friday. It's all right.
It's the gap when a policy like a Federal Reserve is trying to create slack in the system. And I'll come back when it pops back into my mind later. But by shutting down, we created a gap in the capacity. We were able to shut down. We wrote some checks, but once COVID ended and we could go back, we had all this slack in the system. We could have rapid growth, rapid hiring, massive spending, and we wouldn't get to the limits of of capacity for the system. And so you didn't have any inflation develop for the earliest part of the emergence from COVID. They could write checks. Everybody could hire. It didn't matter what people's wage gains were. But that gap came to a close. And at the end of the prior administration, 45, they were signaling they wanted to slow down the government intervention, the fiscal spending from the government, and try to hand the baton off to the private sector. The transition from 45 to 46 saw massive fiscal spending. People would call that fiscal dominance. And the government, they have the authority to print, they have the authority to write checks when Congress passes. And so they just borrow, and they were borrowing and crowding out everything. And when they're crowding out everything, it started to interfere with housing finance. Mortgage rates would go up. People couldn't afford that. And that was the primary dominance from the start of the administration, and it ended up causing massive inflation. And you could see it in the explosion of commodity prices, and then the Federal Reserve called it transitory. Age went away. It's called the output gap. So the output gap means the potential output of the country at any one time. So when COVID hit, the output gap expanded, allowing us to grow massively without hitting the limit, because there was a gap between current output and maximum output. Well, we got up to maximum output with the spending, with the stimulus checks, all of these other matters, but then we kept on pushing money into the system. And if we have a $28 trillion GDP in 46's presidency, we could only add 1%, 280 billion, but we were spending $1 trillion beyond that. You had the interest expense. That's one thing. That's not a big concern. But the actual primary deficit of borrowed money for goods and services, it pushed an extra trillion demand into the capacity. It exceeded it, and it dragged inflation all the way up to 9.4%, 9.3. So we had the fiscal dominance, and fairly late in the first half of 46's administration, Kevin McCarthy made a deal with Joe Biden, and they would reduce the primary deficit, the deficit excluding interest, because interest recycles. It's not really a big issue. I mean, Warren Buffett, every week they're at the auction with their $340 billion. Unless you see a falling dollar or rising rates, there's no problem with the interest. But the actual deficit excluding interest was $1 trillion. And we had to get that closer to 3%, which is 28 times 56, 84. So we got it down on trend. And so we no longer had a fiscal deficit. And then all we had was Powell had raised rates. So now we had a monetary deficit. And that was so high, we still couldn't have any housing activity. Okay. But then Powell saw that the global economy was slowing down. They saw that the demand for money was deteriorating. Inflation was decaying. And the 5 3/8 interest rate, which is the central point of the lower bound 5 1/4 to 5.5 rate, they were having to do massive mop-up operations every night to clean up because the demand for money was way down. You might recall that we had a 10-year at 3.6% just prior to his rate cuts. That's a massive inversion of the yield curve. That said, the willingness of lenders to lend was drowning the desire of borrowers to borrow. So they had to bring down the rate, kind of like putting a tourniquet on. There was no blood pressure in the system. The diastolic in your blood pressure reading was weak. There was going to be a stroke. So we had to put that tourniquet on, cut rates down, and squeeze like you're twisting that child's balloon and trying to make an animal figure. We had to reduce the volume that the existing monetary pressure was taking to get the blood pressure back in the economy. That contributed, in fact, to why the rate steepened so much. Right after they cut rates, we saw a 100 basis point rate cut. It had never happened in the 112 years of the Federal Reserve, where they would cut 100 basis points while the economy was above trend, while inflation was above trend, and the stock market was never high. People will talk about 95.
Yeah, I was going to say 95. Our friend David Dredge was on here on our last episode, and he was talking about his deja vu and how 95 made him think a lot of what's going on, and they did that cut, and it was 75 basis points. So you are correct. No, they had never done 100. So I'm not saying you're wrong, but 95 was similar, right?
Yes. So that's an important time frame. 95. There was some idiosyncratic things. There was a Mexican strain, which was causing problems for Citigroup. Orange County, California, had bought some instruments, some inverse floaters from Merrill Lynch. It was a $500 billion loss. They were trying to unclog some very limited issues. And then 1998, we had another minus 75 over 3 meetings. Okay. But again, that was 75 basis points. And in both of those occasions, if you take a look at the market cap of the S&P 500 to the economy, it was very low. It was the start of a bull market. It was not at a time when the S&P was 210% of our economy. I mean, look back. The Y2K peak was 137. GFC was 105. The roaring 20s, 1929, it was 87%. We are massively overvalued. The NASDAQ on March 24th, 2000 was $6 trillion, and Greenspan allowed it to decline by 57% to $2.5 trillion over 9 months before he cut 1 basis point. And he saved 525 basis points to stabilize the economy, not the stock market. They only wanted to worry about stabilizing the economy, not the stock market. So they let the market deflate 57.5%, while the S&P was deflating 17.3 before a basis point, and they did an emergency cut on January 3rd of 2001. But they went from 6 trillion to 2.5 trillion, and then used 525 to stabilize, and 1.5 trillion bottoming at 1 trillion. We went from 1.15 trillion on November 2008. So the bottom of NASDAQ after the global financial crisis, and for 5,711 days until March 24th, the NASDAQ went from 1.15 trillion to $26 trillion. We're up 25 times. So the 75 basis points when the market's cheap is a lot different than 100 basis points when the market is massively overvalued. And the problem is they were already rolling over, and we look at the peak of a market from the highest price prior to the policy intervention of a rate cut. And if I could just dial back to what we said before you brought up Dredge and why this time is completely different than 95 and 98. no comparison from a structural fixed income standpoint, is that we got rid of the monetary dominance because Powell knew he had to lower rates. Otherwise, mortgage rates that had fallen from October 2023, from 803 down to 611, 192 basis points in less than 11 months. JP Morgan was complaining about the loss of net interest margin from everyone that was able to refinance. We had 187% refi versus the prior year. We were accelerating. We would have gone to 200 and 300 and 400. Mortgage rates would have been at 4% in 4 months. But the
But
Fed
David,
stepped
I'm
in.
going to stop you there. So, but some people are like, okay, I'm hearing this, but there's other dynamics going on now. We know lots of governments are, there's leverage in the system with them. There's leverage in the system with corporates. There's leverage in the system with PE shops. So today, looking ahead, what are you most interested in? You're saying this is one of your best opportunities. So what are your greatest concerns and what are the greatest areas of opportunities that you're seeing? Can you bring us back to today?
So as you bring up your question, and if I were to use a search, what would I hear as the most frequent word?
Oh, for
Leverage.
concerns or opportunities? Leverage, right? Leverage. Yeah,
Because
tariffs and
that's the
leverage.
problem. That's the problem. We have $2 quadrillion of leverage on top of 625 trillion, and we only have 110 trillion of global GDP. So what's happening is we have a massive amount of liquidity. And that liquidity wants to move to where it wants to go. And that's the system. But policymakers are always temporary. We had massive fiscal spending, but that stopped. We had Powell with his rate hikes. That stopped. And then you go to the AI bubble. So we had fiscal under Biden, fiscal dominance. We had monetary dominance under Powell, and then we have AI dominance or equity dominance. That's the leverage you're talking about. It is literally a capital Tower of Babel. It is a black hole. We, on our Twitter feed, have the pinned tweet from October 28th, 2022, when we said it's going to be the greatest period in 15 years for calm, tech, and discretionary, and it's going to last for years. And that was at the bottom. It wasn't about earnings. It was about other factors. We may be able to go up later. But that was the bottom. And we expected a multi-year rally. We didn't expect it to run out of gas after 20 and a half months because it went up too fast. We went up 200% in 20 and a half months. So you would have to be irrational not to borrow a mortgage instrument and sell it short and fund the purchase of more FANG. You would be crazy not to liquidate your XLU and buy FANG. Sell it short. Everything was either liquidated. It reminds me of the movie The Martian with whatever the fellow, Ben Affleck's buddy. And he was having to launch this rocket that weighed so much, and they wouldn't be able to get escape orbit to be caught by, he was left behind to be caught by the other people. He had to get rid of everything to get rid of all the weight. Everybody stripped every asset they could get their hands on, everything they could borrow and sell short to go into that FANG. But it got to a level at 26 trillion for the NASDAQ, 17, 18 trillion for FANG. NVIDIA went up from 500 billion to almost 4 trillion in a heartbeat. So the momentum, the intensity, it was the zeitgeist. Everybody needed FANG. You didn't need anything else. What happens when NVIDIA started having negative divergence on June 18th, 2024, when it didn't make a new high, when the NASDAQ 100 peaked on July 10th. And then the S&P peaked on July 17th of 2024, and the NASDAQ didn't make a new high. None of these made new highs until the policy interference, until the tourniquet of the rate cuts. So this is all the evidence we need that the system wants to send the capital back to where it came from. It's the same thing that happened in the dot-com boom. Software has no mass, so it must travel at the speed of light. Hardware has mass. It cannot travel at the speed of light. Software always accelerates faster than hardware. And when enough time passes, software annihilates the demand for compute growth. You don't need the horsepower of all this compute if the software is fast enough.
Right. So let me slow down for a second. All right. So the leverage, I think that when we think about what just happened over the last month, 2 months, who got really hurt? It was it was a big momentum unwind, right? And we had double levered Palantir, double levered Tesla, pod shots running 5-6 times gross, market neutral. We're seeing the shenanigans, to use your word, to use a little more family friendly term than the term I like to use.
Thank you.
In the like today, and you're seeing it with even within the Mag 7. Like today, Apple's up while everything else is blowing through the 200-day moving average, and then these things are getting dumped. So there's clearly leverage unwinding, and I think you're right about that. But here's the question I have about it is, what is the magnitude of the deleveraging? And can we have a deleveraging that's going to offset any, because these businesses are still doing well, right? These aren't like in bad shape. They're just way overvalued. I mean, Apple trades at 10 times sales and has no growth. It's the most ridiculous thing I've ever seen in my life. And then we basically have a situation where now some of the foreign capital is leaving, right? And that was one of the big things that probably propped this up was the U.S. exceptionalism, the only game in town, as we like to call it, and Chinese money, if they could get it out. Lots of European money, money from all over the world was sitting in here, and then the easiest thing to do is buy the Mag 7 via QQQ or SPY, right? So there's so much. I mean, the Swiss National Bank has reserves of the Mag 7. So when you say we're going to unwind, let's try and put it in perspective. Did we just unwind? How much does this unwind? And because I think that's the key here. It's I think everyone now will agree with you that Mag 7 is the global ATM right now. I think you've made a good call on that. I think that's been right. But where next, to Nadine's point? Where does this go in your mind?
Right. Is it further? Does it continue to be a source of cash, or what happens?
Exactly.
In our view, it hasn't started.
Okay.
Anyone.
And so the decline in FANG has not started. This is not even the appetizer. So I do want to talk about the double counting. In the dot-com era, clicks and eyeballs, people say, oh, that was ridiculous. Well, how about counting Microsoft's expenditures as a great thing and NVIDIA's revenues as the great thing, and they're the same thing? It's almost like you're double counting that. Now, before we go on, I want to be able to give your listeners an important tool in equity that will serve them very well in their space from now till the bottom of the market, which we think is considerably lower. So we'll do it in fixed income after, but I want to give you your equity tool that you're familiar with. Many people are familiar with the VIX, the VIX. It is a symbol that's reported on any ticker.
Volatility index, yeah, sure.
The volatility index, it represents the implied volatility, the expected move by market participants of the S&P 500 for 30 days. Yeah. There's one of those for the NASDAQ. It's called the VIXN, VXN. And a very simple thing every one of you can do every single day when you wake up or every day when you finish your trading. Divide VXN as the spread product, which it is, of VIX, which is the basis. That's normally a 20. When it's above, you're getting ready to be a counter trend move. When it's below, you're getting ready to continue your move in the same direction.
Right.
It's price discovery. It's a compression of volatility. Yeah. That ratio of one volatility to another is a Vega compressibility. We're right now at a Vega incompressibility. You can't get any tighter. They're literally charging $94 for an $80 option. People are saying, I'm only charging a 4% premium to be able to get involved in NASDAQ, to suppress the movement of NASDAQ. NASDAQ's more volatile than the S&P. You do not want to charge the same for a Ferrari as a Volvo. And that's what people just so desperate to get an insight straight. They're willing to sell the calls and the volatility for a 4% premium. Until we normalize, this market's going lower and lower, and there can be waves, but you need price discovered to be discovered at normalization of the relationship. And there's so much hopium in it. People say, I don't care if I only get 4%. The market's going up, so I only get 4%. But that's a leveraged trade. It's another piece of leverage in the system. So if you just watch that, when the market's going down, you're going to have a better idea what the lens, what the path is. Volatility aside, like what happened today? In the middle of the day, the market's down, and Powell says, oh, by the way, if I need to, I'll cut rates. What? He just said he wouldn't. And meanwhile, Besant in the morning, he said, Trump doesn't have an S&P put. No, we have a 10-year note put. We're going to get mortgage rates down. That's our put this time. We want homeowners, which are 35% of the economy, have homes more than their equity in stocks. 35% of the economy doesn't have stocks or homes. So if you want to win a re-election, you get mortgage rates, you get food, and you get gasoline prices down. Because you're going to the gas station, the grocery, a couple times a week, mortgage once a month. You can look at your 401k in a year. You can hold your breath. When Trump 45 took over, we were coming out of GFC. We were sluggish. We had FDR type spending under Obama. Trump said, let's go with the stock market. Let's get more efficient. Let's pump up this bubble. Let's get credit formation going. Let's absorb some of this output gap. And then that's all he bragged about. Go count how many times he said stock market. It was 156 times before the non-State of the Union, State of the Union. He said it once this time, and he said, not so much. Because his number one goal was getting mortgage rates down.
And when he said yesterday was truly unbelievable. I put it on my Twitter that I couldn't even believe. He said, I'm not even looking at the stock market. And then he said, the globalists are selling the stock market. And I was like, well, really making a simulation. But I've had the thesis that you have for a while, that Trump was going to care more about bonds and that we've just been so advanced.
Mortgage rates, not bonds, mortgage rates.
It's a mortgage bond.
No, the point is the goal is to do anything possible to drive mortgage rate down, getting rates, destabilizing the system with tariff on, tariff off, like you're fly fishing, is a policy choice. They're trying to stop businesses from forming credit and business plans, so they stop expanding the stock market. He wants to deflate the market, which was the third thing. It was AI or stock market dominance crowding out home finance. And when you start to go home finance dominance, meaning they stop focusing on the stock market, you're going to see the dollar go up like crazy. People right now are trading the dollar run. Tariffs are good for the dollar. He pulls back on the tariffs. It's bad for the dollar. The dollar's going up for many, many reasons. The euro-dollar system is running out of dollars. The COVID borrowing has to be paid back. Lower mortgage rates reduces the need for liabilities on a balance sheet. So you have to buy your liabilities back, which means you need to buy dollars. There's going to be a shortage of dollars and a shortage of yen. And the weaker the stock market, and I'll give you the example, in the global, the Y2K, the dot-com era, after the peak, the dollar rose for 15 consecutive months, or 15 months to a peak, and then a retest until month 22. So if we continue to see a stronger dollar, a stronger yen, the Nikkei is going to roll over, global equity risk premiums will rise, we'll have the radiation of capital away from the capital Tower of Babel known as FANG, and Trump's goal of lower mortgage rates, lower food prices, lower energy prices. When you weaken credit formation, the emerging markets suffer. I feel bad for them. But Trump's idea, and I'm not a personal supporter of his, but I support him as my president, He wants most of the pain of the output gap to come from the emerging markets, which is why he's being so tough with the emerging markets and the tariffs. China will weaken by 8%, like last time, and everybody else will fall in line. Brazil's at 14.5%, 15%. They're not building tall buildings, so they don't need concrete, so you don't need diesel. We're going to see a reduction in the demand. We're going to see a widening of global output gap, and they're trying to minimize the pain over here to get mortgage rates, oil, and food prices down. And so we talked about what
So
you
how are
can
you
want.
playing that? So how are you playing that? Or for people who, there's people who are going to listen who can do things in a complex manner, and there's people who can do things in a more simple manner. So if you think the dollar's really going down, you could short the UUP or buy a reverse, ETF kind of thing. Or are you long gold? Are you short emerging market bonds or equities, or what? Like
So
how does someone play it?
So first of all, we never use the word play anything on
All
our
right,
spaces
all
because we
right.
take everything very seriously.
No,
And
I know. All
okay,
right.
the way you
We're
would,
pretty fun. The two of us, we like to keep it light.
no, I
Same
totally
start.
get it.
Yes. No, we're
And I
serious
don't mean
people
to
who
be too
have
much.
to, we're serious people who have to,
Yeah,
I guess,
yeah,
keep our heads together. Right.
yeah.
So
Yeah,
how do you
we
So,
think
like to
about the
laugh.
so the way you
strategy?
deploy,
How do you strategize?
the way you strategize, deploy your capital, take your risks. What happens when the dollar, just simple for just average, regular, wonderful people. What do you do when the dollar goes up and you own FANG with 51% dollar beta, meaning 51% of the revenue of FANG is coming from overseas?
Right.
And you're expecting the biggest rise in dollar since the last time the dot-com era blew up. You want to get out of it, but you don't short it. You don't go crazy. We believe in capital radiation. We believe in acceleration. We believe in convexity. We believe in gradualism. So you gradually flow your capital from what's working to what's not, from what's not
Not
working
working.
to what's working. So as you lighten up your exposure, as it persistently shows you, the volatility of NASDAQ is mispriced. People are just too bullish on it. You go to what sectors don't have dollar exposure. The dollar delta. Utilities is 2% dollar exposure. So you do staples, healthcare, utilities. Mid cap is only 25 and small cap is only 15. Now, we believe in capital flow. We want to have teammates. We are not pioneers in investing. Policy can set you back. So we want to make sure that we're adding to strength in sectors that should work when they're working. Now, if you're not a large investor, you could just use what used to be the State Street Global Advisors. Now I think it's Barclays, the sector spiders. And they have 11 sectors, BEFIRE, basic materials, energy, financials, industrials, and real estate. They have VUP, healthcare, XLV, XLU utilities, XLP, and then CKY, XLCom, XLK Tech, XLY discretionary. The money is going to be flowing out of what we begged people to buy max long on October 28th, 2022. By speaking to their advisor first, because we don't give advice. But we said that's what we saw is happening inevitably. They would speak to their advisor, and it would outperform everything by the most. And it actually outperformed us because of even more policy interference. But now there are no tools other than Trump running a $5 trillion deficit, and there's no chance he'll be allowed to do it in this world. So we're looking for a continuing deflation of the credit bubble, of the capital Tower of Babel, into staples, healthcare utilities, small mid-cap, independent mortgage brokers, publicly traded home builders. Did you know that according to the St. Louis Fed, there's $50 trillion of home value and $37 trillion of home equity? The entire value of all of the publicly traded home builders is $250 billion. It's 0.5%. Talk about total addressable markets. All you need to do is stop the policy interference of fiscal, the policy interference of monetary Powell, and the psychological interference of the capital Tower of Babel known as FANG. And as you're deflating this credit bubble, then you're going to see money flowing there. But there's where the problem shows up. And that's why I'm a fixed income guy, although my background was originally in credit and equity. We're fusing it together. A mortgage is like buying a bond and writing a covered call. And if the price of your bond goes up, but you've written the covered call, you lose it and you get cash. And then you've got to go all the way back to go. And then you've got to buy more treasuries. And so what we have is, as mortgage rates go down, they become shorter. As mortgage rates fall, the average life of any mortgage goes down. People get closer to their refinancing, and the value of the option that the bank is short goes up, and then they lose it. They lose the paper. So what ends up happening is banks borrow at risk-free, and they lend at risk-free plus risk, or risk plus volatility. So as mortgage rates go down and they become shorter, and this is one of the few things we really must go over. I'm sorry if it'll take 2 minutes, but we have to quantize and normalize what's the universe of debt that we have in America. We have fiscal debt, federal debt, 36 trillion. It's an average life of 6 years. That's the equivalent of 218 trillion duration years if you cross multiply them, which means that if you funded everything on the short end, you'd have to have 218 trillion because it would be recycling every year. If you did it only in the 30 year, you'd only need 10 trillion of auctions. I said you have all of the capital locked in. So if you take the 218, you divide by a 10-year note, it's like you have 21.8 trillion of federal debt. If you only did the 10-year. If you do mortgages and you have an 8-year average life and you have, let's say, 12.5 trillion of mortgages, to make it easier, that's 100 trillion divided by 10-year. So it takes a block of 10 trillion 10-year notes. Why is that important? You add the 10 trillion and the 21.8, that's 31.8. What happens when mortgage rates go down and people refinance? Instead of having an 8-year average life, you go to 7, you go to 6. We were at 4 average life during COVID, which meant it only took $5 billion worth of balance sheet adjusted for the 10-year to be able to fund all mortgage debt. 5 trillion equivalent of 10-year note. And so what that means is you have all this balance sheet. So when you only have 5 trillion, Powell's raising rates. Mortgages are extending. People aren't refinancing, not returning the liquidity. You had to have people sell the 10-year note, sell. And then you had the government selling and rates. It was everyone everywhere selling.
Right.
Okay.
Let me stop you for a second. So when we go back to that period, right? Because I just want to, you really can go. You're like, I can go, but you can really go. So that's one of the things I think you just want to hammer home. Because when we look at fall of 22 and fall of 23, in everybody, and even look a little bit this January, we had these run-ups where we got to that 5%, and our friend Hugh talked about the Niederhofer rule, that it all blows up above 5%. And that was what I think you saw the mortgage volatility rise, because you're talking about there was no hedging demand and everyone had to hedge as the duration went up and there wasn't as much balance sheet capacity anymore. So you needed guys like me to come in and be interest rate speculating with swaps and stuff, right? Is that kind of what the dynamic is?
So there's an element of that, but so what you're bringing up is the frailty of Citigroup, and I have to point that out because it's the weakest of the big 4 banks. It's the weakest of the big 7 banks, which are J.P. Morgan, Bank of America, Citi Wells, and then Goldman Sachs, Morgan Stanley, and Schwab. So if we look back to October 12th, 2022, the value of Citibank was about $40. It was 3.25% if you look at their market capitalization with respect to their outstanding assets of 2.415 trillion at the time. And the problem is we just lost Credit Suisse. It evaporated over a weekend. People didn't want to lend them money. They didn't see enough equity with all of their liabilities. They didn't see a cushion between their assets and the liabilities. So as Citigroup is weakening in 2022, and we're seeing that, and we're getting ready to go crazy and deprive them of access, buying their credit default swaps, which means you think that they're going to widen, that Citibank goes down, that we start shorting the stock and hedging, and then you do a run on Citibank. The Fed altered policy to block us, so we stopped it. They signaled through the minutes of the September 21, 2022 meeting. Everyone should go in the Federal Reserve and read the minutes. And the minutes said some market participants thought we might hike as much as 100 basis points. We are hiking only 75, and we are looking for the time to lower it to 50 basis points. And what that did was it signaled they were looking to try to steepen the yield curve, which was straining Citigroup with all of their unhedged swaps. Because a lot of the banks don't do adequate hedging, relying on the Fed to cut rates, to steepen the curve, to bail them out, and they make their extra money by having an unhedged tail. So that was the low. They released the minutes October 12th at 2 o'clock, 10:30 after margin. That was the exact low for Citigroup, SMH, SPY, and QQQ, and it was off to the races until July 10th, 2024. And then we're accumulating, we're getting rid of all shorts, getting longer and longer and longer, and within 2 weeks, we're max long. We've put out our tweet, and the Fed signals on November 2nd, when they cut 75, that's it for 75s. 5 trading days later, FANG goes up 192%. That was the day of the low, 5 days after they signaled we are bowing to the frailty. We are responding to the weakness of Citigroup. And that happened again in 2023 after the October 7th, and we had $20 in oil. You had the QRA sell-off. You had the downgrade. Citigroup fell to 3.15, below the 3.25. They were 38.75. They only had 3.1.
David, I want to bring you to today.
Okay.
Yeah. I want to bring you to today. I know Charlie loves Citi. We can go back to the side.
Our partner at Wall Street Beats, Charlie Peabody, who's been bank analyst for a long time. He said he got involved long and that was very much hated. And, I think it had a run. But they
got bailed out by policy interference.
Right.
Free money. But they
can
only continue.
How does this roll? Like walk me through. We are where we are. And what is the timing? What are the signposts you're looking to have happen?
Okay.
On what time frame? What should people be looking at to say, okay, I see this coming?
Okay. So we had what we describe as the peak on July 2024. Yeah. We had a presidential election resolved in a way that nobody expected that uncertainty to evaporate so rapidly.
Right. We
had 100 basis points of easing that is novel. And the yield curve went from minus 50 to plus 48, 100 basis points of steepening in those kind of policy events. And then we started to flatten again. And the market starts to go down. So the peak of the 10-year was January 13th, 2025. It was in this cycle. It got up to 4.89%. And then that day we called a peak in yields because part of the yield curve was flattening. The 10s to the bonds was flattening and showing you there's no more net selling. If you add up all of the yield curve, you had more buyers of Treasury than sellers, even though parts of the Treasury yield could be going up. And once you started doing that, that's the end. That's the end of the bull. That's when you curves flattening. That's when you're putting a Garrett on. That's when you're putting a brake on. That's when you're putting a straitjacket on. And 6 days later, Bitcoin peaked. And then we're starting to see Microsoft, which never made a new high, even with the rate cuts, plumb lower and lower and lower. And they were almost a $4 trillion. Then they're a $3 trillion company. So you're seeing them weaken. You're seeing NVIDIA. And then when you see them announce they're going to cut back on CapEx, you'll have Google and Amazon. That's $10 trillion. With Tesla, just gravity. So flattening of the yield curve right now has lost its latency. Flattening causes pressure. And every once in a while, we get an acceleration and watch for a policy interfere. Now, Powell said, I'm not cutting in March today, but he did say we're watching the labor markets, so we're ready to be a put. So that caused the rally. But until they actually cut, they're not going to be able to stop this. Or should I say, they're not going to be able to pause this, because cuts don't help. Cuts only temporarily give a sugar high. It steepens the curve, but there's 325 trillion of fixed income. It produces 100 billion a day, and it wants to stay in fixed income. And when you don't let us buy the short end of the curve, we'll buy the long end of the curve. And that causes mortgages to speed up the refinancing. If anyone notices, every week, watch the Mortgage Bankers Association. You can look on CNBC. Diana Olick reports it, or Mortgage News Daily. They tell you the speed up of mortgage refinancing. That's why we can't go into recession, because refi is going to explode. It had been blocked for 4 years. It's been hibernating. But the flattening of the curve and also the VXN divided by the VIX is telling you the market is imbalanced. That's leverage. And the system wants to flatten. Rates want to go lower and lower and lower. Look, we had no notes, no treasury notes are above the Fed funds rate today, and now for a full week. The curve is inverted. No one will tell you that. They'll say, well, it's steep to the 2-year. But the 2 year is a risk asset. The Fed funds is a zero risk asset. The curve is inverted. People are paying for the right to buy a mortgage, buy a note, thinking that rates are going to go down and the price is going up. They're not earning money on carry. They're so confident that interest rates are going down, that they're in strength and they got to push rates down, that they're willing to have a negative carry just to get on the trade. And Powell can signal he may cut until he actually cuts. And right now we have 3 cuts priced into 3.5, and that's one of Ben's favorite positions. But the curve is flattening, and you'll notice the gorilla in the room is a statement out of the Fed to try to disinvert the curve, and how quickly it reasserts itself, because my guys are just buying until he says buy the short end. We'll spend a little time on the short end, and then we'll just put it on leverage. When you're at 5.25 and the 10 years at 360, you're not buying on leverage. You're not getting positive carry. You're getting massive negative carry. When you go to 4.25, we did, you're getting closer. What happens when they go to 3.25? You'll get more carry. What about 2.25? So we're going to build, one last thing, we're going to build up massive leverage in fixed income. And we're going to just force those mortgage rates through the floor. And Bessett, the billionaire, is telling you that. That's our policy. 10-year puts, mortgage put. We want rates down. Trust them. They don't want stocks up. They want stocks down.
So are you just going long bonds? Are you doing home builders? Like, what are you doing?
So you can't only go long bonds, because when they policy interfere, look what they did. They caused mortgage rates to go up 115%. Home builders had their worst time. So when they hiked the second time, you already had to hedge off what had been the greatest move. So we started to flatten again, and now you're seeing utilities, the regulated ones. We don't believe in the non-regulated ones, the nuclear power plants we only won't like
so
the
XLU, XLP,
XLB,
you got your healthcare,
ITB. We think you watch XRT, the retail ETF, but you've got to add to strength. You've got to make sure you have teammates, because this is not something where the government wants. The Federal Reserve, they want to stop mortgage rates from coming down too fast to help their banks. So you'll expect them along the way to cut as rates come down. So the trend will be lower, but it will be volatile. We just had a 130 basis point rise. So we like to buy the gradient of the yield curve, the yield that is the lowest yield, and its 2 partners, its adjacency, and then the fastest moving price. And if they start cutting, you hedge your longest piece, because their goal is to stop that, but they will be unsuccessful. So we're radiating the capital out into these ETFs, or if you're a larger investor, you can buy the strongest ones in those sectors. We expect IYR or XLRE to have a lot of that as well, even though commercial real estate has terrible problems, which will not be resolved. But there's so much money in the system, and the government needs to keep the curve steep for it to work the way they want. Otherwise, when you flatten the curve, you cause the dollar to go up, and the 51% delta in the Mag 7 is going to destroy their earnings. We spoke before this quarter and last quarter how people will short the calls for the individual names and they won't lose any money. Call skew was overpriced. There was no
Right.
risk when the dollar was rising for them to get hurt shorting the calls. You can't short the volatility because they're so bad, they were on the downside. But we're now seeing weaker and weaker trading, more and more institutional selling and hedging. And the one thing I would like to add is that 100 basis points caused a lot of short covering and a lot of hot money, and a lot of retail buyers
Sure.
loaded up their balance sheets, but institutions have been unloading, and you're seeing higher and higher volume. And retail individual investors cannot absorb the volume of supply. And what is going on in Europe is exactly a feature of this. We short Europe for 25 years to buy FANG. 90% of the time you want to buy FANG. I want to sell, I want to borrow everything and I want to sell everything and I want to buy FANG 90% of the time. This is the 10%. But you've got to be gradual. We don't expect China or Europe to hold up. But for now they are. Don't fight a tape, but watch what's moving gradually. And we want to be moving to things that are less dollar hurt, because the dollar we expect to go through an all-time high, and we expect the yen to go much higher,
Yeah.
which means less global dollar liquidity. I could make a case for $1 million Bitcoin. I can see it, but I do need to see it go to 10,000 first. I need to see the deleveraging. I need the free hot money to get out of the way. I need the structure, the foundation. How long did it take us to recover from .com? It took till Trump. Yeah, we invented Tesla, we invented Google, and we invented
Facebook.
Facebook.
Yeah.
And who didn't
NVIDIA.
get rich by going to the 52-week the high list, and buying what's ever up there and sitting there for 5,711 days? That's how you make your money. But you need to be an expanding credit bubble where the yield curve is rising or yields are rising. The yield curve's either steepening on its own or it's being pulled up. But you need higher rates so you have more people willing to short treasuries and expand the credit bubble. But when you have the opposite, where rates are going lower, that's a deflation of the credit bubble. And equity is part of that. And equity will go from 30% of fixed income back down to 10.
But can I ask
Right.
you a question, David? Because
Yeah.
sometimes during these types of transitions, money comes out of tech, but it doesn't necessarily go into staples. I call it the Rust plus H, real estate, utility, staples, certain
That's
parts of
great.
telecom
Can
and
I
healthcare,
borrow
right?
that without attribution?
Sure. Yeah, anytime. Rust plus H is where they tend to go, right? But in times of concern, money pulls everywhere. So you might get a little pop initially, and then liquidity becomes more important, and things, pull out everywhere. So how do you think about that? In from what you were saying of the money shall shift, but sometimes it shifts out too.
So I am so glad you brought that up, because that's exactly part of the cycle that we describe. We have the leveraging up, which was the 5,711 days from November 2008 to July 10th, 2024. Then you have the deleveraging phase, where we go to the, what did you call it, plus 8? What did you call it?
Rust plus H. So
Rust
real
plus
estate,
H. Rust.
utility, staples, telecom plus healthcare.
Okay.
Yeah.
So,
You got me
and
excited.
if you look back and you do some charting from March 24th, 2000, you see a 9,000 basis point alpha outperformance of staples versus the QQQ in 9 months. And then utilities lagged it by 10, healthcare a little less, and small cap kicked in. But then you're right, then you get the rise of equity risk premium. So we're not anywhere near the risk of money death. There's still $1 trillion of passive investing. It's just going to be lensed towards what's working.
Okay.
So institutions, hedge funds, algos,
It's
they're
all shifting.
lensing. Individual investors are still stuck on NVIDIA. I'm so lucky to buy it at 110. I'd be lucky to buy it at 20. So institutions, I always say to people, please, when you're buying something, think about who's on the other side of your trade.
Sure.
Why are they taking your paper? When you're selling, why are they buying it from you? We know why they're selling it to you. because the last rise isn't a double top. If you look at a chart, it'll look like a double top, right? For a lot of these
Sure.
texts, it's not a double top. It was a top and would have been a right shoulder, but it was squeezed up by policy interference. So we annotate that and remove all the cotton candy, all the fakery. See where I got you, Ben? Fakery. And so we alter the charts to reflect what's policy. We do partial differential equations with respect to policy. We try to say, what would have happened if the Fed didn't cut 100? The dollar would have been much higher. The yield curve would have been flatter. Mortgage rates would have been lower. NASDAQ would have been hurt by stronger dollar. Retail would be strong. Utilities. Russ
plus H, yeah.
Okay. So what happened is they policy interfered. So the stages are 4 stages. You're in the ascension, you're in the leveraging, everything, short everything by that. Then we gradually flow out. And then if you look back to 2020 to 2000, you'll see after 9,000 basis points of outperformance, then you only had a little more performance. And then the NASDAQ 100 pulled everything down as equity risk premium expanded. But you don't go from a negative equity risk premium to a maximum equity risk premium in a day. You have to start to see more and more decay and more loss, and that's a year or two away.
Okay.
So what we're looking for is the shift, and then we go from the deleveraging to the de-risking that you're talking about,
right,
where everyone's going to sell all equity risk, and they're going to only buy sovereigns, fixed income. And then they'll drive mortgage rates below 4% again. They'll drive treasuries all the way back down to 0. And then the government will do. Powell said 2 weeks ago, I'm not driving rates to 0 for you. But if you do, I will come in afterwards and QE you up. And they'll print until there's so much money, we start cycle again. And you'll see a commodity super cycle. And you'll see the greatest bull market in history. We're at 60 trillion now in the S&P, maybe 55. I think we're going to 200. I don't think we're going to measure U.S. S&P against the U.S. economy the next time. We'll measure it against the global economy, 1 times the global economy. But we have to reset. There's too much leverage. That leverage is unhealthy. It's termites. And it's involuntarism because as the market goes lower, people have to buy back their shorts. In Staples Healthcare Utilities, the Rust 8, at mortgages, you have to buy back your mortgage shorts. How about all these guys in the basis trade? We're getting ready to get long the basis trade, no longer shorting the futures and buying the discounted cash. We're expecting these guys to get blown out because we're losing liquidity to converge. Junk bonds are widening. They're getting worse. Now we have oil coming down. You're going to have all the oil credits join the junk space. And you have EM getting worse. So that's widening. And then the credit default swap guys will be selling short more and more stock with debt on it. So what we want to do is go with what's working in the non-cyclicals gradually with strength. As you see this deflation, it is not a correction. It is not a bear market. It is a reset. It's one of these once every 15-year things because everyone isn't looking at their neighbor. Everyone thinks they're the only one in this trade, but algorithms diffuse risk across all asset classes simultaneously. So if OPEC pulls 2 million barrels, right away you're going to short some bonds. You're going to buy some stock. You're going to buy some oil. You're doing all that. You're going to sell some put skew. Okay? You're doing all of that at the instant of one large episode. What happens when everything goes bad at once? It's a fail. It's a systemic fail. It's everything E2, A2, O2. Everything, everywhere, all at once opportunity. So we watch a sustained outflow, and it doesn't stop. Look back at the old charts of 2000 when we see that mirror image or that mimicking image. And as that continues, it won't last, but it will last for long enough. And then you'll start to see on the new high list, no longer Staples Healthcare Utilities. You'll see the fixed income ETFs, the sovereigns, the TLT, the ZROZ. Yeah.
Let me stop you for a second. So the way you really think about how this goes, and I have this, me and Nadine have the same views. Some of those positions you're talking about are our positions, but like for people listening, right? This is a high level conversation. And I want them to be able to understand that if they've gotten this far, we think about it as an accordion in essence. When the credit spreads widen or they're steepen, the credit works out and you have this over a longer cycle. But what we're talking about here is like this 15-year cycle, and or whatever. We had a credit cycle end in the TMT, right? And then they reflated it by taking rates from 6.5 down to 1. I actually bought a house in college on that one with the IO. Thank you, Alan Greenspan. And then we had the GFC, and there was no more balance sheet capacity. They had gone too far. And then the government underwrote it. So here's the question I have now. There was a lot of balance sheet capacity at the government level at the GFC, and there was tons of balance sheet capacity during the .com, right? Maybe like, Clinton had to, and those guys had to institute a buyback on treasuries because there's no liquidity because there are no treasuries. They're running a surplus in the late 90s, right? So versus now, we have 130% debt to GDP, 102% marketable debt to GDP. And so if we come down and collapse and reset, as you said, how do you reinflate it? Are we going to have to go to the private, because, the thesis is, and our friend Charlie says, we change the rules for the private banks and we get the private banks back in the game and take away these right? Because otherwise, who's going to underwrite this? The U.S. households, I guess, they have a lot of savings. I mean, where's the latent balance sheet capacity that will expand for the next cycle? Because I don't think it's the government this time.
Okay. I'm very glad you asked that, because that's how we started the conversation. The invisible gorilla in the room. The balance sheet is right in front of your eyes, and you think it's not there. It's literally invisible. Powell raised rates by 5.25%. Okay? That's $5 trillion of deficit. There's $10 trillion of T-bills times 1%. That's $1 trillion. When he cuts rates back to zero, as you see yields continuing to melt on the market side, and he's going to follow them down so the banks don't get unstable. He gives you $5 trillion. What happens when mortgages refi and you go from 8-year average life on 13 trillion to 4-year average life? You get another $5 trillion of balance sheet that shows up. And then what happens when $40 trillion of St. Louis Fed certified good old-fashioned home equity gets tapped by lower mortgage rates? You get another $5 trillion of tax collection, and you eliminate the deficit. So people think there's all this supply coming, and they're all wrong.
Okay,
so we're going to be short. We won't have treasuries. George Bush stopped issuing bonds in 2002 because of the surplus. This guy Bassett, he knows what he's doing. When he starts seeing the deficit comes down, he's going to say, I'm going to reduce the QRA. I'm going to reduce the average life because I'm getting lower mortgage rates. Lower interest rates. Right. So there's 15 trillion of the 55 expected trillion of future debt. And we're just going to not have a recession, and all the debt is going to, the liabilities have to be bought back in, because the assets won't need the paired liabilities, because they'll shrink from lower borrowing costs, from the Fed lowering, from mortgage not needing as much because refi speeds up so much. So you want to watch the VXN divided by the VIX. You want to watch the mortgage bankers every Sunday, or every day you can see the rate. And then you want to watch the home. You want to watch the Rocket Mortgage. Again, not advice. That's my Carvana.
Yeah, good stuff, though.
You want to watch. No, but I'm not advised, but you want to watch things that are sensitive. Remember, in the hedge fund community, the kids in the pods who trade equity, they're not allowed to trade in TLT because it would make the risk offset too discontiguous. So they're only allowed equity. So they're not shorting TLT or 0Z or IEF when the Fed cuts rates and steepens the curve. No, They're shorting XLU, XLP, XLV, Russell. They're shorting the home builders. They're shorting Rocket. Watch these things creep back up. It's telling you the kids are being delevered. The capital radiation, the credit bubble's deflating. And we're having leverage annihilation where you have to sell your triple Q as volatility rise, and you have to peel back and unwind your short. And it's a gradual process that accelerates with policy interference, both verbal and actual. Right now, it was only verbal, so we don't expect it to last. When they actually cut 100, it'll slow it down. Look what it did.
So
you saw it happen September 13th. And one last thing. It wasn't the first 50. It was the last 25. If you look on the charts, the 10-year wasn't up that much. Utility staples, healthcare, home builders, they weren't down that much. It was that last that had never happened before. 75s, yes. Never 100 when everything's good. So that caught people off sides. And by January 13th, we were able to call a peak in yields because you saw a flattening of the knob, the note over the bond, the 10-year versus. That's part of the market. If you aggregate all rates, you saw more lending than borrowing. Yes, Ben.
Yeah, and it's interesting because Nadine and I remember that January 13th because that our algorithm told us it was time to buy the SPY there, and it was time to buy bonds as well. And because the TLT and the 10-year, I mean, the 10-year was at like, what, 45 or something back then? And the dollar, that was the peak in the dollar as well. But anyway, that's besides the point. What I wanted to
temporarily.
Before we wrap it up.
The dollar peaked because people trade the dollar on interest rate differential, on tariffs, but there's the natural Anglosphere flow in, and we're having the deterioration of the dollar bubble. You look at the yen. We got to 146 today. We're on the event horizon of a yen carry trade 2.0 with the Nikkei breaking down, and that's going to be more
that's perfect.
recurrence.
I'm going to say, hey, what are the catalysts here? What are the catalysts here? We're sitting here, and we just had couple rough weeks. Like we've been short, right? And we've anticipated this, but I know the average guy, at a pod or my average friend, people have had a rough couple weeks and, they're a little soft. They're used to just everything working. But what are the real catalysts? Like the yen carry unwind, what's the level? Where is the level that Powell, is there an S&P level? What are the guideposts in your mind? And I know,
the most important thing is that at this time is the shape of the yield curve. And also when you watch Bitcoin accelerate lower faster than the NASDAQ. The Bitcoin is 60 volatility. It's the equivalent of TQQQ. If you charted it from March of 21, so the day before the election, they're an exact stencil of one another. S&P is 15 vols, so it would be 4x that. So you have latency. We saw Microsoft go down before NVIDIA, but NVIDIA looks like it wants to accelerate in front of Microsoft because people understand Microsoft's going to cut back on their revenue. And similarly, when you start to see the NASDAQ accelerate lower, you will see Bitcoin front run it, like we saw 45K on Bitcoin on August 5th. But the price structure we have now is not real structure. It's policy supported. It's cotton candy. It's not strength. You have a lot of retail investors who had bought that and absorbed the paper. But institutions are doing hedging, which just means it swells as you go lower. And so when the Vixen is so tight and compressed, like a bushing under pressure, it fails. Until the Vixen is strengthened with respect to the VIX, I know I have people hopiumed up that I'm going to overpay for the right to get into a casino. I'm going to sell NASDAQ puts, sell NASDAQ volatility for I'm going to insure a Ferrari at a Volvo price. That's not sustainable. And when you have Powell say, oh, I'm a backstop. Okay, you get a day or two, but now when we start to break down, you've got all the technical levels. The problem is we're much worse than the technical levels say because the chart was influenced by policy and the dollar was pushed down by the German government changing their constitution. That doesn't happen every day. Oh, we're going to spend $500 billion from the miserly Germans. And I love Germans. Okay. So that's a temporary policy interference. Okay. But now you want to just recognize, once a week, you could take some money, couple of percent from what had been working to what's not working. And if it's only going lower at a certain pace, stay at that rate. But if it gets sloppier, you do more. You want to be climbing onto strength. And we're going to run out of room with what we're moving into in the Russell V up 8 ouch, whatever. But I got to get it once.
Rust plus H.
Okay.
Or think about it as THRS. You got like
THRS.
telecom,
Okay. THRS,
healthcare,
great. Okay.
your utilities,
Okay.
real estate staples.
Okay.
Same letters.
So the THRS will work for a year or two until equity risk premium rise, when people are nauseous that remember, Amazon fell 95% during the dot-com era. MicroStrategy fell 90.8% in the 5 weeks, 25 days from March 10th to April 17th. I always post that in the. That's some talent to drive your company down almost 91% and then get a consent decree and have everyone forget about it. I mean, every time I look at him on TV, I put a filter on, with like jail stripes. But what we expect is when you start to see Bitcoin weaker than the NASDAQ, that's confirmation that the array of volatility is rising. You're not having the flattening. The curve by nature wants to flatten. We're in a world of older and older people, more pensions, more insurance, more savings. They want to grab the long duration. If you buy a 30-year, today you pay $277 for it. You guarantee $1,000 in 30 years, or when we have a problem and you get a blackjack. So that's why the long end of the curve is going down. And as Ben will say, he tracks the swaps with us. People want to lock in the liability for 30 years. They want to know the money's there. They know they can make money. But they don't want to pay a high rate if the economy goes into a slowdown. So they don't want to swap it out for a floating rate. They don't mind paying more when the economy's hot. And that's this natural pull. Since Volcker, when we had 20% Fed funds rates and a 479 basis points inversion, I have to laugh when people complain about 100 inversion. We were 479. That's inversion. We had 500 basis point rallies.
Much less leverage. To be fair, much less leverage back then. Like the dynamics with.
All I'm saying is rates have been going down for 700 years, and we've been tracking them with TYX for 45 years. And a couple of policy things of jacking up rates or spending a little money isn't going to interfere with $625 trillion leaning on your head and the leverage of 2 quadrillion. And then you look at these banks like Citi and JP, there's so much leverage there. So you've got to watch Citibank and divide its market cap by 2.46 trillion every single night to know when the Fed's going to cut next. Because as that goes down, they'll have no choice. They can't allow a run on Citigroup.
Okay. All right. So
it was $68 today.
All right. So let's just fast forward and
land the plane.
Where are rates? Where are rates? Are rates back at zero? Are rates going back to zero?
So this is the one area where my partner, Don Rogerson, who ran the mortgage volatility book, the Gamma book at Goldman for the last decade of his 22 years there before he went to Deutsche Bank, and sat right next to that guy from The Big Short. I believe that bond futures go to a negative implied yield. He's stuck just around zero. But I think the speed of the unwinding of these basis trades, the loss of liabilities, the loss of assets paired against existing liabilities have to be bought back in. How Besant's brilliant in bonds. He's going to start the first day he says, I'm going to reduce some of the QRA and bonds and notes. You better not be sitting short there, because their plan is to get rid of all of them and then cause mortgage rates to go all the way down. That's how you win an election, with a 3% mortgage rate, with a $2 gasoline price, and food going down 1% a month. 1, 2, 3. And that's what we're looking for. But slowly and gradually, always have your money rewarded. Don't have it stale. Add to your success. Don't let the hopium impact your haze. Go with what's working.
But
I think we're going to end on that great note of hopium, Ben. I think we got to end on that one. That one's a good one. Hopium. So I guess we could, Jens and Jens.
I do want to just list so it's concise so they can remember. VXN divided by VIX. You don't want it under 20 and being long. You don't want Citibank market cap divided by 2.46 trillion. You can always go on any site to get their current existing assets. You don't want that going down because you know the Fed has to cut rates to steepen the curve to bail them out. And they'll go all the way to zero. And when all rates are at zero, private credit can kind of disembowel Citigroup, so it's not a moral hazard to the system. And you want to watch the flattening of the yield curve and its persistence and its trend lower, and that's telling you that the credit bubble global, and if you're not watching the yen, and then the yen versus the euro, if you see the yen versus the euro and it's widening, that's a vega, that's a beta, that's an expansion, that's a spread. You don't want that widening and believing there's enough liquidity to hold 51 delta beta export. You know,
I'm going to leave you with this one, David. You know what that is? That's amore. So, David,
that's amore.
So I know we could spend hours longer with you discussing the macro markets, what's going to happen. Thank you for sharing your wisdom, experience with us and our listeners today. How can people find you if they want to get in touch with you or work with you? How do they find you best?
So we do nightly spaces on Twitter most nights, sometimes during the day. They're recorded. So it's hashtag TMOM, hashtag the mechanics of markets, or at Levenson, LEVENSON _David. And you'll see me in front of JFK's brother, Joe Kennedy Jr., was born in the house in my background, and I have a cute little dog named Cosette right in front of me. So we're happy to have people learn, understand the mechanics, so that when we enter this 1,000-day reset and enter the greatest bull market in the history of bull markets, and you have the technique down, you'll solve all of your dreams. You'll get all of your hopes.
Oh, wow.
And you'll have to donate money to charity.
That's big
or
promise
time.
here. Yeah.
That's
amore. That's amore.
Give you a dream.
Thank
you.
Yeah.
Thank you,
all
folks.
my dreams. Yeah.
All your dreams.
Thank you, David.
Thanks,
have a wonderful weekend.
All right. Don't hang